The Relative Strength Index, RSI, is one of the most popular technical indicators for timing trade entries and exits. It measures momentum on a scale of 0 to 100, helping traders identify when an asset might be overbought or oversold. In this comprehensive guide, aimed at both beginners and intermediate traders, we will cover RSI basics, common pitfalls, and advanced techniques like RSI divergence, multi-timeframe analysis, and combining RSI with other tools to improve the accuracy of your trading entries. By the end, you'll know how to effectively use RSI for more precise and confident trade entry signals. RSI stands for Relative Strength Index, a momentum oscillator developed by J. Wells Wilder. It compares recent gains and losses to gauge the speed and change of price movements. The RSI value oscillates between 0 and 100, and it is typically plotted beneath a price chart as a separate line graph. Traders interpret RSI readings to judge market momentum and potential reversal points. When RSI is high, it indicates strong upward momentum. When it's low, it indicates strong downward momentum. By understanding these readings in context, traders can anticipate shifts in market direction. How to add RSI to your chart? On most platforms, like TradingView or MT4, MT5, you can insert RSI by searching for Relative Strength Index in the Indicators menu. The default setting is usually a 14-period RSI with two horizontal reference lines at 70 and 30, representing overbought and oversold thresholds. We'll explain these terms next. By convention, RSI values above 70 are considered overbought, and RSI values below 30 are oversold. This means, in relative terms, the asset's price has moved too far in one direction too quickly. An RSI above 70 suggests the price may be expensive or overextended, while an RSI below 30 suggests the price may be cheap or undervalued on a short-term basis. Traders often view these extreme readings as alerts for a potential reversal. When RSI enters the oversold zone and 30, it's a signal that the market may be due for an upward rebound, a possible buy opportunity. When RSI enters the overbought zone, or 70, it signals the market may be due for a downward pullback, a possible sell or short opportunity. However, it's critical to note that RSI crossing 30 or 70 is not a guarantee of an immediate reversal. These signals work best when aligned with the broader market context, e.g., taking bullish RSI signals in uptrends, bearish signals in downtrends. Beginner traders should treat overbought, oversold readings as alerts to pay attention, not automatic trade orders. Many newbies make the mistake of trading solely off RSI hitting overbought or oversold levels. In strong trends, RSI can stay overbought or oversold for a long time, and price can continue running in the trend direction. For example, in a sharp downtrend, RSI may drop below 30 and remain oversold while the price keeps falling for an extended period. A trader who buys just because RSI fell below 30 could suffer continued losses as the downtrend persists. Conversely, in a strong uptrend, RSI can hover above 70 for an extended time while price keeps climbing. Why does this happen? RSI measures momentum, not absolute price value. In a powerful trend, momentum can stay extreme, high or low, without immediate reversals. As one analyst notes, a market can stay oversold for extended periods of time when it's trending down. In these cases, relying on RSI alone gives false signals. The key lesson: never use RSI or any indicator in isolation for entries. Always consider the overall trend and price action context before acting on an RSI signal. In the next sections, we'll introduce RSI divergence, a technique that addresses this issue by combining RSI signals with price action patterns to improve reliability. Trading smarter begins with the right broker. And that's XM. Transparent pricing, advanced technology, and support from real experts, all in one place. Discover low spreads, fast execution, and no hidden costs. XM lets you trade confidently across Forex, commodities, indices, and more. New to trading? Learn with free webinars and educational tools before risking ascent. Already experienced? Take advantage of professional leverage and tight execution. Whatever your level, XM helps you trade smart, not just fast. Tap the link in the description and start trading smarter with XM today. RSI divergence is a powerful concept for more accurate entries. Divergence occurs when price action and the RSI indicator move in opposite directions, signaling a potential shift in trend momentum. There are two main types of regular divergence. Bullish divergence, price makes a lower low, downtrend weakness, while RSI makes a higher low. This indicates selling momentum is waning despite the new price low, hinting at a possible upward reversal. In other words, the bears are pushing price to a new low, but the RSI shows that the downward momentum is weaker than before. And early signal bulls may soon take control. Bearish divergence. Price makes a higher high, uptrend exhaustion, while RSI makes a lower high. This suggests buying momentum is weakening even though price hit a new peak, warning of a possible downward reversal ahead. In short, the price rallied to a fresh high, but the RSI failed to confirm that strength, which often precedes a trend pullback or reversal. Understanding divergence helps resolve the false signal problem mentioned earlier. Instead of blindly trusting oversold or overbought readings, divergence forces you to look at how the indicator's pattern compares to price's pattern, adding a layer of confirmation. Divergence often provides an early warning of trend changes. When price keeps rising or falling, but RSI begins to stall or reverse, it's a clue that the trend's momentum is fading. To visualize these concepts, let's look at real chart examples of each divergence pattern. In the bullish divergence example above, the RSI was in oversold territory during the first price low. Then on the subsequent lower price low, the RSI stayed higher, a sign that the sell-off was losing steam. Traders seeing this could prepare for a potential trend reversal up. In the bearish divergence image, even though the market hit a new high, RSI's lower high signaled that the rally's momentum was weakening. This often foreshadows a down move, as it did here. Key point: divergence does not predict the exact moment of reversal, but it provides a strong clue that conditions are ripe for one. Many professional traders use RSI primarily as a divergence tool because it yields more reliable entry signals than basic overbought/oversold readings. Divergence helps in several ways. Filters false signals. By requiring a disagreement between price and RSI, divergence setups naturally filter out many false signals. A price extreme confirmed by RSI is often just a momentum continuation, but if RSI refuses to confirm a new extreme in price, it often means the trend is weakening. This reduces the chance of entering a trade too early on just any oversold/overbought blip. Early trend reversal clues. Divergence can act as an early warning system. It shows momentum shifting before price actually reverses direction. Catching a turn early can mean better entry prices and bigger profit potential for the trade. Traders who learn to spot divergence can often enter right around market turning points, improving risk-reward. Works across markets and timeframes. RSI divergences occur in stocks, Forex, crypto, etc., and on any time frame. It's a universal principle of momentum versus price behavior. You can apply it to daily charts for swing trading or 5-minute charts for day trading. The concept remains valid, though higher timeframes generally give more reliable signals. Clear visual pattern. Divergences are visually easy to spot for those with some practice, especially the obvious ones. This clarity helps traders be more confident in their analysis. Many charting tools even have built-in RSI divergence indicators to highlight these patterns automatically on the chart. It's important to note that while divergence greatly improves the quality of RSI signals, it's not foolproof. Sometimes a divergence can appear, but price drifts further before truly reversing. Or a divergence may only lead to a small pause instead of a full trend change. A saying in trading is that divergence is a warning, not a trigger. In practice, This means you shouldn't trade solely because you spot a divergence. Instead, use it as a cue to tighten your analysis and look for additional evidence confirmation that a reversal is indeed unfolding. We'll discuss confirmation techniques shortly. Not all divergences are equally significant. Experienced traders categorize them by how wide or tight the swings are. Wide divergence, high quality. The price swings forming the divergence are large and obvious, making a wide separation on the chart. For example, price rallies strongly, then drops, making a clear higher high, while RSI makes a clearly lower high. Big, distinct waves. Wide divergences are easier to spot and often indicate a more pronounced momentum loss, thus considered higher probability signals. In wide divergences, you often see price move sideways or choppy before reversing, which is a sign that the prevailing trend is losing control. Tight divergence, subtle but important. The price swings are smaller and closer together, making the divergence less obvious at first glance. For instance, price makes a marginal new high, and RSI makes a marginal lower high. The difference is subtle. Tight divergences can be harder to spot, sometimes switching to a line chart makes them clearer, but they still indicate momentum exhaustion. They might lead to smaller reversals or require more confirmation, but they are just as important as wide divergence in a complete strategy. Additionally, divergences can be classified by whether RSI reached extreme zones or not. A divergence that occurs with RSI actually hitting the overbought, oversold region, 70 or 30, is often more significant because it shows the indicator at an extreme when momentum started to shift. A divergence that occurs when RSI was near the extremes but didn't quite touch 70-30 can still be valid, sometimes called a Class B divergence. But some traders view it as slightly less potent. Think of it as a quality hierarchy of signals. All RSI divergences are useful, but a wide divergence at extreme RSI levels would rank as a very strong signal, whereas a tight divergence just outside the extreme zones might rank as a moderate signal. This hierarchy can guide how much confidence you place in a given setup. Regardless of type, any divergence should still be confirmed with price action, which we'll cover next. Spotting a divergence is step 1. Step 2 is to confirm that the anticipated reversal is actually happening. This step is crucial for turning a good analysis into an accurate entry. Rather than jumping in as soon as you see RSI diverging, wait for additional price cues that the trend is indeed reversing. Here are effective confirmation techniques. Trendline break. Draw a trend line along the recent price trend. For a downtrend, connect recent lower highs. For an uptrend, connect recent higher lows. If you see an RSI divergence signaling a reversal, wait for price to break the trend line in the opposite direction. For example, in a downtrend with bullish RSI divergence, you'd draw a downward sloping line above price, a break above that line, especially with a decisive candle close, confirms buyers are seizing control. A trendline break is clear visual evidence of a trend shift. Support resistance break. Identify a recent support or resistance level near the divergence. A reversal is confirmed when price breaks above a resistance in case of bullish divergence, or drops below a support for bearish divergence after the divergence occurs. The breach of a key level shows momentum reversing direction. In fact, one pitfall example, a wide bearish divergence in an uptrend failed because price never broke below support. The uptrend simply resumed. Only after the level or trendline break should one consider an entry. Candlestick or chart pattern. Look for a reversal candlestick pattern or small chart pattern at the point of divergence. For instance, after a bullish divergence you might see a double bottom, a hammer candle, or bullish engulfing pattern. After a bearish divergence, you might spot a double top, a shooting star candle, or bearish engulfing. These patterns provide a second source of confirmation that aligns with the divergence signal. Indicator cross or filter. Some traders use a secondary indicator for confirmation. For example, they might wait for the MACD to turn up or a moving average crossover after an RSI divergence appears. Or they look for increased volume on the breakout move. These additional indicators can add confidence, though be careful not to add too many requirements, which could cause you to miss trades. Why confirmation matters. An RSI divergence can sometimes appear mid-trend and not result in a major reversal, essentially a head fake. Waiting for confirmation prevents entering on mere speculation. As one trading guide emphasizes, don't act on divergence alone. Wait for a more comprehensive confirmation from price action. This typically means accepting that you might not catch the absolute top or bottom, but in exchange, you dramatically increase the probability that your trade entry is timely and accurate. Multi-timeframe tip. A clever approach is to spot divergence on a higher time frame, then drop to a lower time frame to fine-tune entry once confirmation triggers. For example, say a daily chart shows bullish divergence. You could wait for a daily trendline break to confirm, then switch to a 1-hour chart to find an even earlier entry signal, like a small pullback or consolidation breakout, to get a better entry price once the daily divergence is confirmed. This marries the reliability of higher timeframe signals with the precision of lower timeframe entries. Finally, always remember to manage risk once you enter. A logical place for a stop loss on a divergence trade is just beyond the recent extreme price, e.g., below the latest swing low for a bullish divergence entry. If the trade is valid, price should not go on to make a significant new extreme beyond the divergence point. The default RSI setting, 14-period 70-30 levels, is not one size fits all. To improve accuracy, you can tweak RSI parameters to suit the market's behavior. Trending markets. In strong trends, consider using a more sensitive threshold. For example, raise overbought to 80 and oversold to 20 if a trend is very powerful. This way, RSI will only signal extremes when the move is truly overstretched. You may also increase the look-back period slightly, e.g., 14 to 21, to smooth out noise. One guide suggests that in a strong uptrend, a 14-21 period RSI with 80-20 levels works well, while in a range-bound market, a 9-14 period with 70-30 is better. Range-bound or low-volatility markets. Use the standard or even narrower thresholds, e.g., 60-40, to get more frequent signals in quiet markets. Shorter look-back periods, like 9 or even 7, can make RSI react faster, which helps in choppy, mean-reverting conditions where quick oversold, overbought swings lead to bounces. High-volatility markets. If you trade cryptocurrencies or very volatile stocks, RSI can whip around quickly. Some traders use a shorter period, 5 to 9, to catch extreme swings early, paired with more extreme thresholds, 80-20, to avoid too many false signals. This gives quicker signals suitable for fast markets, like scalping crypto on a 5-period RSI, adjusting on the fly. You might also adjust RSI on a case-by-case basis. For instance, if you notice an asset's price often turns when RSI hits pounds or 60, not 70 on rallies, then 60 is acting effectively as overbought for that asset. Some experienced traders will shift their RSI overbought, oversold lines to unconventional levels, e.g. 65-35, based on backtesting and observing that particular market's behavior. The idea is to align RSI's sensitivity with the environment. By doing so, studies have shown you can improve signal accuracy. One source notes that tailoring RSI to market conditions improved trade accuracy by up to 15 to 20%. Of course, don't over-optimize to every blip, but be aware that the default 1470-30 is just a starting point. If something seems off, too few signals or too many false signals, consider small adjustments. Always test changes on historical data to ensure they indeed would have added value. For truly accurate entries, it helps to consider what RSI is indicating on multiple time horizons. Multi-timeframe analysis with RSI can drastically improve your odds of success, by ensuring you trade in the direction of the dominant trend and use the lower time frame for precision. Here's a simple approach. Higher time frame, trend context. Check RSI on a higher time frame chart, for example daily or 4-hour if you trade 1-hour entries. A quick method: see if RSI is mostly above 50 or below 50. Values above 50 on the higher time frame suggest an uptrend bias. Below 50 suggests a downtrend bias. You can also note if the higher time frame RSI is nearing extreme levels. That might warn the larger trend is exhausted. Use this view to decide direction. E.g., if the daily trend, RSI, is bullish, you prefer to look for buy entries on the lower time frame. Lower time frame, entry timing. On your trading time frame, say 1 hour or 15 min, wait for RSI signals that align with the higher time frame direction. For example, if the daily trend is up, look for bullish RSI setups on the hourly chart. Maybe an oversold dip, RSI less than 30, on the hourly that gives a buy signal, or a bullish divergence on the hourly. If the daily trend is down, do the opposite. Short when the lower time frame RSI swings high. Multiple confirmation layers. You can even add a middle time frame for additional confirmation. As an illustration, daily chart, RSI greater than 50, uptrend bias. 4-hour chart, RSI dips to 30-40 and turns up, signaling a setup in an uptrend. 1-hour chart, RSI was oversold and now crosses back above 30 and perhaps shows a bullish divergence or breaks a small trend line. Entry trigger. This layered approach, trend plus setup plus trigger, significantly boosts confidence in the trade. The higher time frame keeps you on the right side of momentum, and the lower time frame ensures your entry is well timed. It helps avoid the common mistake of taking a valid RSI signal in the wrong context. Like a bullish divergence that appears in the middle of a massive long-term downtrend, higher time frame would tell you the deck is stacked against that trade. By syncing up time frames, you effectively stack the odds in your favor. The big picture says the trend is up. The medium picture says a pullback might be ending, momentum ready to resume up. The small picture gives the exact trigger to buy. This technique can drastically improve the win rate and the accuracy of your RSI-based entries because you're filtering out low probability signals and only acting when multiple conditions line up. To further refine entry accuracy, consider using RSI in conjunction with other tools. A layered analysis will confirm what RSI is telling you and weed out weaker signals. Here are a few powerful combinations. RSI plus support resistance. This is one of the simplest and most effective pairings. An RSI extreme is more meaningful if it occurs at a key price level. For example, RSI dipping below 30 right when price is at a strong support level is a high probability buy signal. Oversold plus support. Likewise, RSI greater than 70 at a known resistance is a strong warning of a potential downturn. Overbought plus resistance. In practice, you might patiently wait for an asset to reach a support zone and see RSI flash oversold. That's your cue to look for a bullish entry. The support gives a logical price floor, and the RSI indicates an oversold condition due for a bounce. RSI plus moving averages. Moving averages, MA, can help identify trend direction and potential entry points. If you spot an RSI bullish divergence, it's even more convincing if around the same time you get, say, a bullish MA crossover or price reclaiming a key moving average from below. For instance, a 50-day above 200-day MA bullish crossover could reinforce that a longer-term trend is turning up, aligning with your RSI divergence signal. Some traders also use an MA as entry trigger, e.g., go long when RSI diverges bullish and price closes back above the 20-day moving average. As confirmation, the short-term trend turned up. The MA acts as a secondary check on price momentum. RSI plus candlestick patterns. We touched on this earlier with confirmation. Classic reversal candlesticks, hammer, shooting star, engulfing, etc., can validate RSI signals. For example, Imagine RSI shows bearish divergence at a peak, and then a bearish engulfing candle appears. That combo is far more compelling than RSI divergence alone. It gives both a momentum sign, RSI, and a price action sign, candle pattern, that the trend might reverse. RSI plus volume. Volume spikes can indicate capitulation or exuberance. If you see an oversold RSI reading accompanied by a huge volume climax, perhaps indicating panic selling exhaustion, it adds weight to a bullish reversal scenario. Conversely, an overbought RSI with declining volume on the last push-up might signal a weak rally ripe for reversal. Volume isn't a requirement, but it's a nice supporting factor if clearly aligned. RSI plus other oscillators. Some traders use dual oscillators for confirmation. For instance, pairing RSI with stochastics or MACD histogram. If both show divergence or both generate an overbought, oversold signal together, the probability of a reversal may be higher. Be cautious though, since many oscillators are correlated, using too many can be redundant. Still, something like MACD can sometimes confirm momentum shifts that RSI spots, or vice versa. Interestingly, some traders prefer RSI over MACD for divergence signals because RSI often gives crisper and clearer divergence indications. But both are useful, and you can choose based on which fits your eye. In all these combinations, the philosophy is the same. Use RSI as the primary signal, but only act when another factor also supports the trade. This multi-factor confirmation greatly increases the likelihood of a successful entry. It prevents you from acting on every RSI blip and instead puts focus on high-quality setups where multiple clues point to the same conclusion. One more advanced concept to be aware of, especially for intermediate traders, is hidden divergence. This is a form of divergence that indicates trend continuation rather than reversal. For example, in an uptrend, if price makes a higher low but RSI makes a lower low, that's a bullish hidden divergence suggesting the uptrend will resume. In a downtrend, price's lower high versus RSI's higher high is bearish hidden divergence, hinting the downtrend will continue. Hidden divergences can be used to time entries in the direction of the prevailing trend, buying pullbacks in an uptrend or shorting bounces in a downtrend, with accuracy. They are another tool to keep in your arsenal as you become more comfortable with standard divergence. The RSI indicator can be a fantastic aid for timing your trade entries, but only when used thoughtfully. For beginners, the first step is understanding RSI's basics, the significance of 70-30 levels, and why context matters. We emphasize that overbought or oversold readings alone don't guarantee reversals. Price action can defy these signals in strong trends. The real power of RSI comes when you incorporate divergence analysis, confirmation techniques, and holistic market context. Let's recap the key practices for using RSI effectively. Use RSI divergence as a primary signal. Divergences, bullish or bearish, alert you to potential trend changes early. They help you avoid chasing trends that are running out of steam, and instead, position for the next reversal. Always confirm with price action. Wait for tangible proof of the reversal, such as trendline breaks, support, resistance breaks, or reversal candlesticks. This step significantly boosts your entry accuracy, ensuring you're not just guessing based on RSI alone. Align with the trend, multi-timeframe. Improve your success rate by taking RSI signals that concur with the higher timeframe trend direction. Filter out counter-trend signals, or use them only for quick scalps with caution. Adjust RSI to the market. Don't be afraid to tweak RSI period or thresholds if needed. A little customization for volatile versus steady markets can go a long way in sharpening your signals. For example, using 80-20 levels in a runaway trend can save you from premature entries. Combine RSI with other tools. The best trade entries often come when multiple indicators or analyses say the same thing, whether it's RSI plus support level, RSI plus moving average, or RSI plus a news catalyst. For those who mix fundamentals, convergence of evidence is what gives you confidence to pull the trigger. Practice and learn from examples. Go through historical charts and identify where RSI gave great signals and where it failed. Study those scenarios to internalize what a high probability RSI setup looks like. The examples we discussed and the charts shown are a great starting point. Try to find similar patterns in your favorite markets. In summary, RSI is best used as a complementary tool, a powerful component of a broader trading strategy, not a standalone magic bullet. When you apply RSI in conjunction with sound price analysis and risk management, it can significantly enhance your entry timing. Traders who master RSI divergence and confirmation techniques often find they can enter trades with more conviction and less guesswork. Finally, remember that no indicator is 100% accurate. Always manage your risk on every trade. Use stop losses, position sizing, etc., because even the best-looking RSI setup can fail due to unforeseen market events. By staying disciplined and following the structured approach outlined above, you'll be leveraging RSI in the smartest way possible, as a tool to tilt odds in your favor for more accurate, higher probability trade entries. Happy trading, and may your RSI signals be strong and your entries precise.